It's my pleasure and honor to introduce our next speaker, Mr. Ramesh Mahalingam. Ramesh is a chartered accountant and rank holder from November 1983, a recipient of our chapter's Excellence in Finance Award in 2017. He has held several C-suite positions in banking and industry across MNCs and regional institutions. He then decided to transition into entrepreneurship in late 2010 when he set up Ideal Management Consultants, now known as Ideal Capital Management Consultants in Dubai, to what he calls fill a felt need in the market. Ideal Capital is a boutique firm that specializes in transaction advisory and consulting in finance and strategy. He heads a dynamic team of 10 that has executed over 300 transactions and assignments, including valuations across a gamut of sectors. Ramesh has been a member of several boards and investment committees. He has also been a long-standing assessor of the MRM Award. He's a familiar figure in the educational and professional circles in the region. His role as election officer in some of these forums has earned him the moniker of Alsatian of the UAE. He's a long-timer in the GCC, spanning over 3.5 decades, and currently lives in Dubai with his wife and partner at work, Jayaji, also a chartered accountant. Please welcome Mr. Ramesh Mahalingam.
Let me welcome you all. A very good morning to all of you. Coming to Abu Dhabi is like coming back home. And I mean it in the truest sense of the word. We got married in 1991, and that's the year we came to Abu Dhabi from Dubai. And the chapter has been the one place where we totally feel at home with friends. And quite rightly, some of you have been members from then or even earlier. It's such a warm feeling to be back here. Let's lighten up the mood a bit. This is a fun topic, and I want to show you how. Quick show of hands. How many of us would have been involved in a corporate transaction, a buy or a sell of a company? Right hands up. Only right hands, please. Now keep that hand there. And how many of us on the sell side? The left hand. That's a few. Okay, hands down. Thank you. Now I know that there have been more sells than buys. Okay, what I've done is I have given equal weightage in the talk to both. I also noticed that there's a large component of the audience that has not done any transaction yet. So this is meant to be more of a how to conduct a transaction rather than go into all the theoretical aspects, right? So I'll dive straight into the how to aspect of it. And for those of you who've done the transactions, during the Q&A, we'll delve into the deeper aspects. We'll sort out all queries to the extent I know the subject. And I must confess, I am still learning. This is a topic where I don't think anyone can call himself an expert ever, because it's vast. It's vast to the point that the kaleidoscope of human behavior is all captured in this one topic. And that's the reason that I keep unraveling new truths about human psychology, especially as it is applied to the sphere of money. And therefore, it's one of those keep learning, keep discovering journeys. I've been doing transactions now for about 22 years, to be precise. Yeah? Can we have this operational, please? Very simply, this is not about racing through a slide deck. We'll dwell on the few slides we have, but we'll dwell on them in a practical sense. Who are the people involved in a corporate transaction? You'd be surprised. It's much more than the buyer and seller. So you have a seller who wants to sell his company or a part of it to a buyer. He appoints a sell-side advisor to do so. He sells it to the buyer. The buyer appoints a buy-side advisor. This is a classical case, and I'll tell you the alternatives. The buyer, first and foremost, wants to know how much it's worth, and so he appoints a valuation advisor. Now, the valuation advisor may be the same person as the buy-side advisor, yeah, but it could be different. The roles are different, and hence I've identified it separately. The buyer then appoints a financial due diligence advisor to diligence the company, and we'll delve into detail in the next couple of slides on this. He also appoints a legal advisor, and you see, it starts to get complicated. There's a crowd of people actually working on this. Unlike a real estate transaction where you have a buyer, a seller, and sometimes the same broker who brokers the two. There are very few parties involved. Here, you'll find as we go along, see, there's a legal due diligence advisor. Often they are the same party, but don't have to be. Yeah? So they diligence the target company from a legal perspective, check out all their contracts and so on. We'll get into the details in a bit. There's also the commercial DD. Now the buyer may or may not know that field where the target is doing business in. And so he wants to go into the commercial side of it. Is there a market? Is there a future for this company? Or is it all fluff? Or is there some imminent regulation that's going to wipe out this company and make it obsolete? So he appoints a commercial due diligence advisor. All this is based on the complexities of the business and the circumstances in which the transaction is occurring. There could be other DD advisors too. You could have an environmental due diligence done, particularly if it's an oil tank owning company that you're buying. There could be environmental issues. If it's a fisheries company you're buying, there could be environmental issues. There could be technical due diligence. There could be a lot of equipment which need to be checked out technically, like in the case of you buying a car. You're buying a car from somebody who you saw on the Craigslist or the advertisement in the classifieds. You don't know that person. So what do? You take with you a mechanic. Bhai, isko check if the engine is okay, if the chassis if there's any brake, leak, etc. And then you also take with you somebody who can tell you, is this aesthetically, is this car up to scratch? Maybe a car salesman comes in to advise you. So technical due diligence is another. You could have tax due diligence advisors, because this company may be having operations in multiple countries whose tax laws you're not familiar with, and so you may call a tax due diligence advisor, and the list continues. You may have an HR diligence advisor to see if the HR is up to scratch, or whether you're going to have to make big changes after acquiring the company. Yeah, HR changes. Now, so much for the buyer's side. On the seller's side, he too will need a valuation advisor. In fact, he'll need a valuation advisor even before he appoints the sell-side advisor, because he wants to know how much he should expect for the company. Now, it's natural for a seller to ask for the moon. I built this company from scratch. I've lived with it. I've emoted with it for 30 years. How can I sell it for a song? I don't want to be shortchanged. In fact, that's usually the refrain from people who come to me and say, Rameshji, I want to sell my company. The retiring entrepreneur. That's a very recurring theme in this market. They've come here in their 70s and their 80s, and they came in as an employee, like many of us. And then, like some of us, they were bitten by the entrepreneurial bug, and then they started their business. And in due course, they grew it. Now, UAE was in its formative years through the 70s, the 80s, and the 90s, and the 80s. And so they actually, you literally couldn't go wrong in business unless you made a point of going wrong with it. And so you grew the business. A lot of businesses have really grown and been thriving through this boom. And so why would I want to, if I'm an entrepreneur, why would I want to sell it for a song? But then, much as I know how to sell my products, I know nothing about selling my company. Enter the advisors. So what do? I advise people in that position, before you even appoint a sell-side advisor, Mr. Entrepreneur, Mr. Retiring entrepreneur, please find somebody to give you a valuation. We can do it, but in this capacity and not in a seller capacity. The two capacities are actually different. Get a proper valuation, get an objective valuation, not something that is loaded with emotions. So once they have a proper professional valuation, that becomes their benchmark. Now they may have an argument with the valuation advisor. He may be valuing it at far lower than their aspirations. But you know what? It's better to go through it at this stage than in front of a buyer at the negotiation table. Yeah? So a valuation advisor for the seller. And then they would need a legal advisor too, because this stuff is laden with agreements, legal agreements, performances. Don't think that just because you sold it, you have nothing to do with it. No, in the case of a car, it might work. The moment the registration of the car is done at the motor vehicle department, you're done with it. You forget about the fact that you even owned a car. You just got the money and you maybe taken a flight. But not with a company. There are some responsibilities that linger, and you want to, as a seller, minimize those, and I'll walk you through that step as well. Sometimes, instead of the buyer doing the due diligence, see the financial DD advisor? Do I have a pointer here? Instead of this financial DD advisor, the seller himself appoints an independent professional firm of repute to conduct a due diligence as if a buyer was doing it. So he does it. The seller gets to know what the weak points in his company are. Maybe he fixes them and then goes to the market. And if his due diligence comes out clean or relatively clean, that's good enough to talk to potential buyers. This is done by mature entrepreneurs, mature sellers. Private equity firms tend to adopt this route. And then what happens? There is a data room, a virtual data room in the cloud where the seller or his advisor or both together, they upload all the documents that require to be seen by the buyers. So that data room is a very important element in the transaction. Patty, just give it a second. There's a couple more boxes coming. Oh, okay. Thank you. There's no one else coming. So, in the transaction, there is also an escrow agent. We'll check out their role a few minutes down the road. There's potential escrow agent. This is an option, and I'll show you in what cases this option is used. Then you have to go and the shares have to change hands and the check has to be handed over or the payment has to happen. So you go and do that in front of the notary public in this country. The process here is different in different countries. I'm keeping it local because chances are that greater that you do a transaction here, a buy or a sell of a company or a stake of a company. So you go in front of the notary public, who is part of the Ministry of Justice, the Judicial Affairs, part of the court system. So both buyer and seller have to go and sign in front of the notary public, and then you go to the DED, which is the Registrar of Companies in the UAE, to go and lodge your ownership. Then the trade license and the Chamber of Commerce certificate and so forth, they get changed. Yeah. So this is a very quick glance into who are the players and what are their broad roles. Okay. Now I'll show you the steps from a buyer's perspective. If there's anything that you need to stop me about, showstopper, do so. Otherwise, I'll continue. We'll have a Q&A session at the end. So as a buyer, you may be having multiple motivations to buy. You may want to acquire in order to grab market share. Maybe you have a customer concentration that you want to overcome, so you acquire another company in the same field where you're getting new customers and you're reducing your customer concentration. By reducing your customer concentration, you manage to actually increase the valuation of your company, by mitigating one of the risks. Or you may do what is more common, a backward integration or a forward integration. Yeah? Why? Because you are a sizable player and you want to grab the margins by backward integrating of your supplier, or you want to grab the margins of the guy who's actually owning the customer, that is by forward integrating. So you get better control over the supply chain of which you are a part, and thereby you increase your profitability. You increase your profitability, you increase the valuation. So my thesis to a lot of my clients is, go buy this company. A, you're increasing your turnover, fine. But B, you're mining more into the supply chain, and thereby and what you're paying here may not be anywhere near the multiples that your company will attract when you put your company in the market. As I said, there could be multiple considerations. You could have geographical expansion, lateral expansion, yeah, and just about a variety of reasons. There's a new trend that I have seen over the past, few years, say 10 years, that people are actually going out with roll-up consolidation models. One of the first examples of roll-ups in the Dubai market, or in the UAE for that matter, is Life Pharmacy. I saw this guy acquire one pharmacy, and the next week he was acquiring another and another and another. I think they own more than 150 or 170 pharmacies today. By having all these acquisitions in one fold, what is he doing? He's actually getting the advantages of bulking. All his insurance contracts, all his supplier contracts, all his logistics contracts, yeah, all of them, yeah, he's able to command better prices than if it were a mom and pop pharmacy. And I noticed others have done similarly. So the whole pharmacy market here seems to be 80% of it at least, seems to be in the hands of just 3 players. That's one classic example. There are other examples of hospital acquiring medical centers or clinics as feeders of inpatients. Yeah? So there could be a whole host of reasons why a buyer may be acquiring. And sometimes it could be at the seller's behest. A seller comes and thinks, you know what, these are good buyers to sell it to. The seller wants to cash out and go. And so he comes to the buyer. So the buyer is actually receiving an offer rather than going out and seeking acquisition targets. The next is, the buyer, when he's offered or when he is received teasers, etc., if he expresses interest, the seller will ask him for an NDA, and so you sign an NDA and then ask for more information. More information could be of the likes of financials, audited financials, management accounts, and so on. Then you go into, when you start negotiating, start discussing with them, get into a term sheet. A term sheet is also called an LOI, letter of intent. So you sign a letter of intent to express your intent to acquire the company. There are several clauses that go with this, and I'll tell you in the next slide the specifics of this. Then once you sign a term sheet, you need exclusivity, and that's the stage where the buyer appoints the legal due diligence advisor, the financial due diligence advisor, and whatever the requirement is specific to that business, he appoints the due diligence advisors. And then the due diligence advisors, they take their time, and for that amount of time, as a buyer, I wouldn't want the seller to go shopping this to other buyers, because I'm investing money in paying for all the due diligence advisors. I want exclusivity. In fact, I will go to the extent of telling the seller, any approach you get from anyone else to acquire your company, you need to tell me about it. To that extent. Not just you don't go and approach, even others' approaches, they must be rooted to us. Yeah? So that's exclusivity for you. The due diligence is one of the most important fundamental responsibilities a buyer will have to exercise. because he needs to know what he's buying. He needs to know what risks there are. He needs to know what undisclosed liabilities, if any, there are in the business. What's he buying up to? Is he buying a problem, or is he buying a profit-making asset? And if the due diligence reveals holes, we will see in a minute how to tackle those. But some of them result in price adjustments. Then you go into the definitive agreements stage. This is where the share purchase agreement is discussed. It will be typically a lengthy document with various clauses. Yeah, we'll have a little chat about that. And then you get into the stage of statutory documents, where you have a share transfer agreement, and you go and get the shares. The shares change hands, and the money changes hands. So this is a quick overview of the process. Yeah, this will set the stage for us to dwell into each one on a practical note. Now, the converse of the buy side largely is the sell side. Yeah, not the same, but largely. Sometimes the seller produces the VDD. In all cases, they produce a teaser. They prepare the target for sale. Now, preparation of the target for sale is something that many sellers just take it for granted. I urge people, whoever has a plan to sell their company, I urge them to actually go into depth as to what is missing. Do the housekeeping properly. Get all your accounts audited. Get an internal audit done. Get your registrations, your ISO certifications, and whatever. Keep them all up to date, so that when a buyer comes, you don't fail the DD. You score on all those points from all perspectives. Here, a sell-side advisor would give you the appropriate advice as to what preparing your target for sale is. The seller needs to identify the potential buyers. Yeah? So list out who you think might be potential sellers. List out which buyers would find synergy by acquiring your company, and make that list and work that list. Next is, having had that list, now work with your advisor, sell-side advisor, to approach these targets. Now there are two broad methods. One is you approach a few, or one by one, and talk to one at a time. This is the rifle shot approach. You shoot one. If you don't hit the target, shoot another. So approach one potential buyer. If that doesn't click, approach the next one. But this could be time consuming. Your company's information is kept confidential, but you're doing it in serial fashion. It's one at a time. The other approach could be a controlled auction. Your sell-side advisor approaches a number of potential buyers, calls for offers, shares the information memorandum after an NDA and so on, calls for offers. There's a first round of offers that you collect. You see which are the ones that make the shortlist, and then those, you open up your data room to those, and they do a deep dive, and then they come up with final offers. Everything is time-bound. Now this you would do if you sense good amount of interest in the market. If your company is a unique company which would not be of interest to a decent number of buyers, then you may well have to adopt the rifle shot approach. And in this market, I have seen the controlled option is very scarce. It's usually one at a time, or maybe approach 2, 3, and then start, one shows interest, you start talking to them. Yeah? So it's in serial order, more often than not. So once you've approached the buyers, then you discuss the terms with them. Here on, it's the converse of what we saw in the buyer's case. You have the short list, you have the term sheet, the due diligence, the sale purchase, the share purchase agreement, and I'll talk to you about the shareholder agreement in a bit, and then the statutory documents for completion. And now comes the stepwise. Yeah, it's a busy screen. That's why I give you the preview. This is a screen where you see these are the major steps for a buyer: origination, agree broad terms, due diligence and post-due diligence stage, the legal agreements stage, and then the completion and the settlement of the deal stage. Yeah? So these are the broad stages. And what marks completion of each stage? The documents that each stage produces. The NDA it marks the end of all these steps under this stage. The term sheet, or the letter of intent, or the MOU, or the heads of agreement, as it's differently known in different places, marks the end of this stage. The due diligence reports from the various due diligence advisors marks the end of this stage. The legal agreements, the share purchase agreement, the shareholder agreement, and in the case of a part sale, you may even have a management agreement under which the seller says, I continue to manage maybe until I sell the company fully to you. So it could be a creeping acquisition, stage-wise sale. So the management agreement could be one of the legal agreements to be discussed. Broadly, these are the ones, but there are individual cases where you may have variant agreements in addition. And then you have the documents showing change of title. This is the trade license, the various statutory documents where you are shown in the cap table as the acquirer. So let's run through some of these. Now, as a buyer, we talked about what the motivation for your deal is. Set clear criteria for the acquisition. If you are wishy-washy about what you're going to acquire and why you're going to acquire, that acquisition will go in circles. It's much the same like if you're going to do up your office, you call an architect and he gives you a plan, a drawing. You may iterate on the drawing, but once you sign off, he builds the partitions and the lighting and the AC ducts to that plan. You're not in the business of asking him to do something of his liking and then tear the walls down and rebuild them every time. No, that's not the way to go about it. So set clear criteria is like the architect signing off, giving you the drawing for signing off. Identification of targets, reviewing of teasers, we talked about them. If your criteria are met, then you talk to the owners. Yeah? It's always good to use your sell-side advisors or your buy-side advisors, because the advisors can talk to the other party's advisors without the emotion. They can get an idea of what is the price range we're talking about. The range, not maybe a fixed figure. Or if not the range, the minimum expectation of the seller. It's good to know that early enough to know whether this is in your ballpark, within your ballpark, or outside your ballpark. If it's affirmative so far, then you go ahead, sign the non-disclosure agreement. NDA is non-disclosure agreement, also called confidentiality agreement. And then you, on the quiet, you try and find out who else is there who's looking at buying this asset. This is a negotiation ploy. This will drive much of your behavior going forward. If there is no one else, then you might afford to stiffen your attitude a bit. But if you know that there are several people vying for this asset, then you'll be on the double. You will make yourself flexible, yeah? If you badly want the asset, that is, and if the price is right, and if your value extraction criteria are all met, then you will bend a bit more than otherwise. So this is a very important step, often not paid much attention to, yeah, by buyers in real life. Then, once you signed the non-disclosure agreement and got the information memorandum, now if it's a complete information memorandum, this document, together with the financial model backing it up, should be adequate for you to be able to value the company. At least the initial valuation. And that initial valuation is one of the key things that you will negotiate with the seller. It's not just the price, you will also value what you're buying, the deal structure. Are you buying the assets, or are you buying the whole company, or are you carving out some of the assets and some of the liabilities and buying only the rest of the company? So you will make a value decision. What is of value to you in that company? And if your due diligence later shows you, it's happened with us. We did a due diligence of an entity where we found there was no balance confirmation from a single accounts receivable, from a single customer. So the entire receivables were wobbly. So we advised our client, the buyer, to carve out, keep the receivables aside, and tell the seller, whatever is collected after the transaction from this list of receivables belongs to you, Mr. Seller. We will only partake in the new receivables. So we sort of segregated it. Pre-completion receivables belongs to seller. Post-completion belongs to the company where we are a shareholder. You could do exactly the same with the payables too. You could say, all payables disclosed and undisclosed will belong to you, Mr. Seller, if he is continuing in the company. If he is not continuing in the company, you have a problem. He's not there. So what do? You do an adjustment. You say that we will segregate all the receivables received from this lot for the next X number of months, maybe 6, 9, 10, 12 months. And out of those collections, we will pay all your payables, and whatever is left at the end of it, we will pay it over to you, or you will pay us the difference. So this is the receivables payables adjustment, sequestered from the rest of the company and taken out. Now, one other element in the price negotiation, and we are all accountants, we ought to be totally up on this. One other element of the negotiation is the valuation of goodwill. Now, many sellers think that their company, the business is worth so much, and on top you have to pay them a valuation. Now, it is for the advisors, the valuation advisors, to educate the sellers that, look, what you think of as goodwill is already rolled up in the valuation. There's no two things. The profit is actually the result of everything put together, including the goodwill. So please be mindful of this approach from sellers. And this needs to be sorted out, as early in the game as possible. Sometimes you cannot arrive at the price. There's a gap between what the seller is asking and what the buyer is willing to offer. So I have used the earnouts as a very viable method. I've told the sellers, look, if the company is indeed as profitable as you project it to be, and mind you, all projections seem to be a hockey stick. Up to last year, we had 3% growth, and from next year onwards, we're going to have 23% growth. So all projections are optimistic, especially if you're a seller. And it's for the buyer to logically bring the seller down rather than just beat him with words. So the way I say it is, okay, if, in the case of a partial sale, if the company indeed performs beyond this level, then there will be a price adjustment retroactively done. Alternately, if the company fails to perform, then either a price adjustment or a share adjustment. Give the buyer a higher stake to compensate for the lack of performance. So earnouts are a very commonly used via media to bridge expectations, price expectations between buyer and seller. Now, other key terms maybe as to whether you will pay for it in one go or you'll pay for it on a staggered basis and so forth. So all these are captured in a term sheet, the letter of intent and so on. Now, primary or secondary, what is the nature of the transaction? Now, in some cases, the seller might want to offload a part of his shareholding, but at the same time, he wants to get the buyer or the investor or the acquirer to inject money into the company. Now, whenever money is injected into the company, it goes into the share capital line, fresh shares are issued, and the buyer thereby becomes a shareholder or acquires a certain portion of the equity on a post-money basis. Now, sometimes, or more often, I have found that this is a combo, part primary and part secondary. A secondary means you're buying the sellers, the owners, the founders, the entrepreneurs' share out. No money goes into the company in a secondary transaction. In a secondary transaction, money changes hands between the buyer and the seller. The company does not get any richer. In a primary transaction, the money goes into the company, nothing goes into the hands of the seller. Usually, when sellers sell, they take this opportunity to get some cash in their hands. Who knows? Throughout the life of the company, the guy has probably been plowing back the money into the company to grow the company, to where it is now. And so he's really not enjoyed any cash in his pocket as a result of running the company, probably. And so those kind of entrepreneurs, they tend to go part primary and part secondary. So the term sheet should reflect that. Binding, non-binding offers. Term sheets can be binding, which means both are committed. They can be sued later if they renege from the deal. A non-binding offer is one where the buyer is not committing himself to the deal. He is indicating interest, but he is not legally bound by what he has put out. Now, the seller obviously wants to see a committed buyer. So sellers try and ask for binding offers, but buyers try and put out non-binding offers. Now, who decides whether it should be binding or non-binding? The commercial considerations. If as a seller, I find there are 5 buyers vying for my business, hey, I am going to get settle for no less than a binding offer. Why should I settle for a non-binding offer when I have 4 other buyers who are going to be disappointed just because I picked up this person's offer? So I want definitiveness, I want clarity as to the rest of the process, so I will push for a binding offer. But if I'm doing the rifle shot, and I'm just talking to one buyer, then chances are that I might settle for a non-binding offer with a deadline. If this doesn't go through by this time, there's a long stop date in there. If it doesn't go through by this time, then I'll open it up to the next buyer. So it's a practically a very important clause. Now the buyer, as I told you earlier, the buyer would expect an exclusivity because he's going to spend on due diligence advisors. The bigger the bill, the due diligence bill of the buyer, the more as a seller I am convinced that he's committing himself into the transaction. But at the same time, he wants me to commit to him, even though it's a non-binding offer. He wants me to, as a seller, to commit to the buyer by saying that, okay, for the next so many days, weeks, months, I will not talk to any other buyer. Now, what do you think the buyer is going to say? I want exclusivity for 90 days. The seller might want to keep the exclusivity period as small as possible, because if it doesn't work, he doesn't want his hands cuffed for all that period. So he will want a smallest exclusivity period. But typically, what I do is, I go in for the minimum acceptable to the buyer, and then I do an extension, auto extension, unless the seller comes forward and says, I've got somebody else I need to approach. So smaller periods, but with an auto extension clause. Very rarely do you find that somebody puts a stop to this exclusivity and moves on to another seller in this market, another buyer, I mean. This is another very, very important clause. As a buyer, you want to know, or you want the advantage of being able to draft the legal agreements. There's something called a drafting advantage. So if as a buyer, you appoint the lawyers to draft the share purchase agreement, the shareholders agreement, and whatever other agreements, then the tendency for your lawyer is to put in as many legal protection clauses for you as his client. And then when you launch it on the seller starts clawing out of it. This is a better situation than letting the seller draft the legal agreements. He drafts them with minimal commitments, minimal clauses, minimal covenants, and he parks it on the buyer, and the buyer has to keep adding and beefing up the legal commitments of the seller. So I always prefer, if I'm on the buyer's side, I certainly don't settle for anything less than the buyer. It's an expenditure. You have to spend on your lawyer, but it's an expense well worth it, because you can then pack it up with all kinds of protection you want as a buyer who's paying good money to acquire this company, and particularly if the seller is selling and going away. If he's gone, then you're left holding the baby. Mind you, the day you acquire the shares of a company, let's say you're buying it fully, that day onwards, you are responsible for everything vis-a-vis the external world. Even for stuff that happened 10 years ago, 20 years ago. You're actually taking ownership of everything that's got to do with that company. Assets, liabilities, contingent liabilities, hidden liabilities, past sins, everything. Why would you want to do that? Unless you're very sure of two things. That you've diligenced it, your advisors, you've appointed the best advisors who give you all the assurances that they possibly can. And secondly, you have the seller's warranties, the representations and warranties, committing to you that, hey, should anything be there in the past that will cause a loss to you, the buyer, in the future, thanks to some sins or misdeeds or mistakes of mine as an owner in the past, then I will make good that loss to you. The buyer, for his part, wants this from the seller for eternity. The seller, on his part, will say, hey, I'm going to give you this warranty, this warranty, this warranty, and so on, but there is a limited period within which you can claim on those warranties. The seller will try to limit the warranties of the buyer, and the buyer will want to stretch those warranties as far as possible for his protection. The last thing I want as a buyer is to be paying for the sins of the seller. Chuna laga ke chala gaya. No, we don't want that to happen to us. Not on my watch. Yeah, that would be your attitude as a buyer. You appointed the DD advisors, legal, financial, commercial, tax, technical, insurance, environmental, etc. But to do the DD, you will need access to the VDR. Yeah? There used to be physical data rooms in the past where a lot of box files were kept in a room with no windows, no nothing, no photocopier, no phones, mobile phones allowed for you to take pictures. People used to have to read, study, go in and day out, take nothing away. Those were the olden days. Nowadays, it's all digital. VDR is a virtual data room. It's on the cloud. You afford access, and you are able to track who went in, for how long did he stay, what documents he can download and what he can't. You have a complete log, and you also have a visibility of who did what in your data room. You can tell the interested party from the less interested party, or from the uninterested party, from the buyer's side. So VDR access, you can monitor the progress of the DDs. Okay, cool, thanks. Discuss the DD findings. That's very important. What they come up with, what are the weaknesses, what are the missing pieces, what are the things that you need to talk about in your agreement with the buyer, with the seller as a buyer. Discuss the DD findings. If they are material, you may have to renegotiate the deal. Maybe a price adjustment is called for, or maybe some promises, some representations, some warranties, some covenants have to be given. Or maybe you may say, I don't buy this asset, like I told you about the receivables. Maybe I don't buy the inventory, because maybe the inventory weighted average cost pricing is all over the place. So I don't buy that, I carve that out. Maybe you recontour the deal. And then, once you've renegotiated the deal, mind you, at any of these steps, the deal could fall through. It doesn't proceed. It's a bit like, in the olden days, like my time. When we got married, the boys' family and the girls' family used to discuss, and there's so much of diligence happening. At any stage, the marriage or the engagement, the potential engagement could get called off. It had to pass through all those stages in order for an engagement to happen, and then the marriage to happen. Here, it's kind of similar. The whole process is one of cautiously proceeding from step to step to step. And this, my dear friends, is why I don't believe a deal will happen until I actually see a deal has happened. It ain't over until it's really over. It ain't over until the cash is in the bank. That's the nature of this entire activity. And when it's over, I tell you that jubilation is exactly like how it was when you passed your CA exam. It's really euphoria when a deal actually happens. So, arrange for the lawyers to draft. Whoever is the stronger party manages to grab the drafting advantage and get his lawyers to draft the share purchase agreement. Along with the share purchase agreement, the seller has to disclose a whole lot of details. That's called the disclosure letter. Anything that the seller has disclosed, the buyer can't get back at him because he's already made disclosure. I've already told you, this is a weakness in my business through my disclosure letter. Now you can't hold me responsible for not having told you. No. Even if there is a loss arising out of a disclosed item, it's the buyer's business, buyer's loss, because the buyer has chosen to go ahead with the transaction, with the deal, even knowing this deficiency or this fault. That's the importance of the disclosure letter. Therefore, I urge you, work with your advisors, if you're on the sell side, to make sure that the disclosure letter throws in a whole laundry list of all the small and big things. Because what you think may be small may be a big thing for the buyer tomorrow. If it's a partial acquisition, you will have a shareholders agreement. Why? Because both of you are going to be on the cap table. Both of you are going to be shareholders. What is the relationship you're going to enjoy working together? Who will manage the company? Who has the authority to sign things off? Who will be on the board? There's a whole host of things in the shareholders agreement that you will need to agree with the seller if you're a buyer, and vice versa. Now, before you actually buy, you may tell the seller, hey, before I buy, you need to complete this, you need to get your ISO certification, you need to get your audit completed, you need to do this, you need to do that, you need to get this certificate, etc., etc. Then only I'm going to pay you the money and complete the transaction. I'm not going to buy it as is. So CPs means conditions precedent to the completion. CSs mean conditions subsequent to the completion. You may say, okay, I'll go ahead and buy it, but you have to commit to me that within the next 3 months, you will appoint a chief operating officer, for instance. That's a CS. Or within so much period, you will do this and you will do that. That's a CS. Now, the last bit is actually procedural, not so much conceptual, but there is one very interesting element in it. Yeah, you'll get all the regulatory, he has to get all the regulatory clearances and so on for you to go ahead and sign. The signing, that is completion, is a very important milestone because that marks the end of the transaction, technically. That's the day on which you, as I said earlier, you pay the money and you collect the shares, right? Now, what if this company has 5 entities, one in Dubai, one in Abu Dhabi, one in Oman, another in Saudi, another in Kuwait? When are you going to pay the check? The guy has to give you 5 companies' share ownership. So what do? You both agree, buyer and seller agree, that there will be an escrow agent to whom the seller, both confide in, both have confidence in. The seller, whatever document he has to submit, will submit to the escrow agent as and when he is able to. The buyer will pay his check, banker's check, for instance, into the escrow agent. The escrow agent will wait until both parties have done whatever they were supposed to and then hand them to each other, respectively. So they acquiesce in the credibility of that escrow agent. Who are the escrow agents in the real world? Banks, although they don't like being escrow agents, I have seen in practice. Law firms. Law firms are, especially the high street law firms, the big ones, they are credible, they're seen as credible parties. Yeah. There are specialist escrow agencies you can get. At least I know of one that I use in the DIFC as an escrow agent. It's a subsidiary of a very large international firm. Not lawyers, these are corporate advisors, the secretarial agents, right? And then once that is done, change of ownership has happened and the sale has gone through. The same converse of this is on the sell side. I'm happy to share these slides with you all so that you have a ready reckoner guide in hand. These are largely mirror reflections of the buy side. But on the sell side, I must say, as an advisor, I love doing sell side advisories as much or more than the buy side advisories, because selling is a different skill set than buying. Buying, though we've done, hard to say you sit as a CFO, financial controller, people are selling to you all the time. We know how to put up our attitude and approach as a buyer. But as a seller, it takes a lot more sweat and toil. It takes a lot more preparation to put up a company for sale. And the thrill you get out of selling is far more. And by the way, in terms of remuneration, buy-side advisors don't get remunerated nearly half as much as sell-side advisors. That is one very good reason. Great, so that's like a summary. I am conscious that have I overshot the time? Looks like, yeah? But any questions you have, either now, later, whatever the format, happy to answer.
Hi, Ramesh. Thanks for a fantastic presentation. You were at the best, as you always. Just a quick one. On the buy side, don't you think that bankers should also be part of the group? Because once you give a binding offer, I mean, you need to have your finances in place.
I did not delve into how you're going to arrange the money. Yeah? You may have the funds. You may do a transaction where no money changes hands. I've done one such transaction where I was on the sell side. The company had a lot of loans. I wanted the buyer to take these loans because my seller did not have the money to pay the loans out. So no money actually changed hands. But assumption of those loans was indeed the consideration for the transfer. So as I said, in the kaleidoscope of real life, there are so many different things that come up. Every day is a new learning experience. You have to arrange for finances. If you're going to pay a big bill for the purchase, you'll have to arrange your finances. But that takes us back into the area of corporate finance rather than transaction process.
Okay, thanks.
Paddy.
Ramesh, wonderful session.
Thank you.
A question from your experience in terms of the deals which you have seen. Could you give us 2 or 3 examples of why deals don't become successful?
Yeah. Great. I just have to clarify, deals before they close or after they close? Before they close. Okay. I've seen a case where, it went to the wire. We agreed the share purchase agreement. We agreed the shareholders agreement. And we did nights. We started at 9 in the morning. We finished at 4 in the next morning. We did this for 3-4 days at a go. And I had 2 top law firms. Yeah, I was on the sell side. What happened? After all these documents were agreed, the buyer asked for the quarterly performance report. By then, time had elapsed. So after our DD and everything, he asked for the quarterly performance report of the seller. That quarter, the seller made a loss. The whole thing fell flat. Now, I personally think the buyer used that as an excuse to opt out, because maybe his board was telling him that this is an aggressive, ambitious purchase. Be that as it may, that was the straw that broke that camel's back in that instance. It could be any of anything. Another thing I'll tell you, in these negotiations, it can get heated. On one clause, on one word, gross negligence versus negligence. Oh my God, how much of conversation. And sometimes what happens is the people get so involved in it, they feel offended if the other party is challenging their statement or not agreeing. Emotions, tempers flare to the point where they think, I can't do business with them. Yalla, get out. It can just be personalities. Or you can suddenly find a hardening of stance of the buyer or the seller. It's people, you see, at the end of the day. And so as an advisor, it is my job to keep the calm. I often tell the buyer and the seller, you guys meet only when we've cleared the ground for you. We cure the pitch. I talk to the other party's advisor. We advisors clean up a lot of whatever has to be cleaned up. We try and reduce the buyer-seller meet to a formality, if possible. It's not always possible, but we try and minimize the exposure of these two directly. Because, when they come with their swagger. They have the check writing ability, and one has the, all the wealth and the check writing ability brings with it certain innate characteristics. We want to keep that for the pleasantries rather than for getting into the moment of the transaction. So things have happened where people have not disclosed. A sudden disclosure of something throws the transaction out of gear. In one case, the revenue was not being adjusted for customer rejects, customer returns. Some peculiar kind of non-compliant accounting was happening, which did not get caught by the auditors, and it has been going on. The DD advisor found it, and the deal did not go through. If this kind of a material thing is kept away from us, God knows what else is. That type of a thinking started prevailing. In one case, the guy was running a very nice valet parking business, huge. And he was showing profits. And I was on the buy side, the DD advisor, not the buy side advisor, DD advisor. And I found that he's showing a profit, and when I asked him for completeness of expenses, are there any expenses that are excluded, I actually found that the same company owner, the seller, is owning a labor camp. He's housing all his hundreds and hundreds of drivers over there, and he's not charging any rental cost to the business. No wonder it's showing a profit. The moment you impute the rental cost, the economic cost, into the P&L, it's a loss. And that deal stopped that day, literally. The buyer, who I was representing, got so furious, he called the other guy, the bloke, and then put an end to this transaction. So this is not the kind of person I want to buy a company from. I don't know what else is lurking in your company. So ever so many reasons, So it's on a wing and a prayer that we hope that a deal actually gets to the end. The majority of times, however, statistically, is the price discussion. The expectation of the seller and the expectation of the buyer is probably so far apart. Just last week, I had a disappointment on that score. Famous buyer. This is a company where the seller is very emotionally attached to, it's a lady in her case, seller. And the buyer is corporate. The buyer is not even the man himself, it's his finance team. They said, ma'am, this is the value, this is the max we can ever pay, and it fell short of even half of her expectation. So, fortunately, none of us wasted too much time progressing on that transaction.
My question is, on this, can a seller relieve himself of liability, past liability, by way of some publication of some in the...
Come again, can seller?
Can a seller relieve himself of past liabilities, contingent, anything, through some legal document and publications?
Yes, actually seller will try to do that. Seller will say, this is my responsibility. He may limit it in two ways. Limit it in terms of time. After 6 months of the transaction, you can no longer approach me for any claim. Time limit. Or he may say amount limit. No amount greater than the X amount will be due from me, the seller, to you, the buyer. So he can limit his, it's like an insurance company saying that insurance claims need to be raised within so much time, or the maximum payout will be limited to this ceiling. Similarly, the seller is actually doing the role of an insurance company to the buyer. He's insuring the buyer, but he's placing limitations on how much and how long he will stay insured.
Thanks, Ramesh. Ramesh, you started with the what actually, and then we moved to the how. I just want to go back to the what, the behavioral or the stimuli behind an acquisition process. And, wanted to talk about two things actually, and if you can touch upon from your experience, in fact, two things. One is from a valuation perspective, and one is just a behavioral aspects of the buyer-seller. So the behavioral aspects, the valuation aspect, I just wanted to get into the winner's curse or the buyer's remorse type of a thing. And that is the behavioral aspect, as in the how will tell you, the valuation advisors can give you the best of the advice, but the behavior drives your ultimate behavior. The second thing is, there is always a deal heat or a deal fatigue. Yeah, and that's also behavioral. So just from your experience, what will you say about that?
I only talked about the transaction mechanics and until the date of completion. There's a huge area beyond, which is the integration. There are more transactions that actually fail in integration than, way more, than those that succeed. The buyer has all these expectations from that acquisition. When the cameras have clicked the close of the transaction and the share price or the market value, etc., has all happened, the deal doers, who are often the smartest of the lot in the buyer's organization or the seller's organization, they move on to another deal, and then realizing the value that was projected from that transaction is left to people who don't enjoy the limelight, people who are not monitored that closely, and so that integration is often a vast area of failure. So if you're a buyer, please make note of all the motivations, all the causes, the reasons why you bought. The raison d'etre of the deal needs to be documented, and people need to be made accountable and responsible to realize those values. So that is where a lot of acquisitions have not delivered the promise. Yeah, so that's on the one side. And so that is truly buyer's remorse. When you look back 2 years after the deal, you will see, oh my God, we made all these assumptions. So that's a very often occurring phenomenon. And there are specialist consultants, apart from all of these, who are integration specialists. A buyer should think of engaging them to make sure that they are, right from the beginning, they are there and they handle the transition. The first 100 days are the most important. All the uncertainties at the target, the people, oh, will I lose my job, the commitments and so on, all of these have to be taken into account in those 100 days. So that's on the one hand. As to valuation, see, valuation is in the eye of the beholder. The reason the deal is happening is because of a mismatch in the valuation expectations. Actually, regardless of what the seller's stated position is, the seller probably feels that he has more use for the cash than for the company. That's why he wants to sell. He's probably got some better uses. There was a transaction I did where the seller was happy to let go of this IT company. Why? Because he wanted to become a builder back in India. He saw a real estate boom back in his state, and so he wanted to find cash, take it, and sell it. So that's that. Those expectations regarding the future of the company are different. The buyers felt that this company is on the takeoff panel or takeoff platform for huge growth. So that's how a market is made anyway. So valuation is a completely big, huge area. We love doing valuations because, and I think Rohit rightly said at the beginning, it's about the story. It's about a story, and I would go as far as saying evaluating parts of the story, putting them all together, and finding the synergy value of the whole thing. Yeah. So this area is a multidisciplinary, multifaceted line where transitioning from being an accountant at one time to being a transaction advisor has actually pulled in all that I've been learning. She said, Suma said, I passed in 1983. Can you imagine from that day onwards till today, whatever I have learned, or if even before qualifying for that matter, everything is being synthesized in the course of a transaction. And we accountants, I dare say, are far more suited for becoming transaction advisors than any other discipline. You'll find lawyers wanting to be transaction advisors, and some of them are good transaction advisors. However, when it comes to numbers, that's a big zero in their minds. They need to depend upon certain others. And numbers form the foundation, the pillars of a transaction. The valuation and the mismatch in valuation and the ability to tell the story behind the numbers, past, present, and future numbers, that makes this thing viable for accountants. So, in your career, I really, if I have to wish somebody well, a finance guy or finance person, I would say, have a chance to do one transaction. The adrenaline, the excitement, the euphoria is unmatched.
Thank you, sir.
Thank you all.
Thank you. So I'm sure there might be more questions, and Ramesh sir is available with us. So you can ask in the break or even after. So there will be official coffee break after the next session. So, sir, we would like to express our heartfelt gratitude to you for your wonderful presentation, and you really taken to the practical aspects and making us deep dive into it, and from the origination till the conclusion, as well as the full deal. So thank you, sir.
Thank you. Sorry if I have overstepped my time by a margin, but this is a topic where there's so much, you can do a whole day on this.
We would love to hear you, sir.
Yeah.
And
Thank you.
as our expression of gratitude, we would like to present a small memento on behalf of all the chapter members. So to present, I invite our Vice Chairman, Mr. Krishnan, the CEO of Finance House, TK Raman Sahab, and Jaya ji. Raman sir and Jaya Mahalingam. Yeah, please, sir. Yeah.
You must be right.
The assets go on the right side too.
So what goes on the left side?
Whatever is left.